Hi there. This presentation will give you a quick overview of your business financial reports and let you see the reports that you should be using within your business. There's three key reports that you should be familiar with. The first one is income and expenditure, or it's also known as profit and loss account. The second one is your cash flow statement, and the third is your balance sheet. These reports are all interconnected, and you can easily produce them if you're using a good computerised accounting system. You'll find some information on accounting systems within the Business Basics section, so if you don't have one already or are unhappy with what you've got, take a look at that section. So let's look at an example income and expenditure report. The first thing that you would record is your sales, and from that we would deduct the cost of those sales, whether it be the products you've purchased from suppliers or the cost of making the products. And what you're left with is your gross margin. And you'll see from this example that the gross margin as a percentage of sales is 33.3%. And we'll come back to this later, because managing your gross margin and knowing the percentage and how it can fluctuate is a key part of managing your business profitability. Then we have the overheads, which are all the other costs of your business. And in this example, I'm showing probably a reduced list compared to real life, but you can see the sort of things that are included. And that gives you a total overheads of 12,100. So for this particular month, we are making a profit before tax of 2,900, which is the gross margin minus the total overheads. The second report we should take a look at is the cash flow statement. And you'll see here that it's a fairly simple report. You have cash in and cash out. The cash in this example is represented by payments from customers, and cash out is supplier payments plus all the expenses that you have incurred. The difference between this and your profit and loss statement is that this represents the actual cash leaving the business or coming into the business, and we'll explain that more in detail later. You'll see from this example that we actually have a net cash out position where we've paid out more cash than we've taken in. And this is quite a common feature, especially in smaller businesses, where you can struggle to get customers to pay in time, but your suppliers still expect to be paid by you. So this is why the report is so important, knowing this position and knowing how to manage it. The last report is your balance sheet, and the balance sheet shows three key things. First of all, it shows what assets the business has, i.e. what things it owns. Secondly, it shows what liabilities you have, which generally means money that you're owing to others. And thirdly, it shows what is left for the shareholders or the owners. So if you take the assets of the business less the liabilities, whatever is left belongs to the shareholders or the owners of the business. So here's an example of the balance sheet, and you'll see that at the top, the first thing we have is fixed assets. And these are things like property and equipment, things that are pretty permanent and would take a fair degree of effort to dispose of and don't tend to change from day to day in the running of your business. The second section of assets would be current assets, and that consists of things like your stock, debtors, the money owing to you by your customers, and cash or money at the bank. We then have current liabilities, and these are the opposite to current assets. This is money that you are owing others. So creditors represents the money that you would owe your suppliers. Bank overdraft, I don't think I need to explain to anyone. Government taxes, and there may be other items that would be included there. So we have a total current liabilities here of 92,500. And if you take current assets minus your current liabilities, that's known as net current assets. And in this position, you really want to have more current assets than you've got current liabilities. Otherwise, you're in a bit of trouble because you don't really have enough cash or stock or money expected from your customers to pay the money that you owe others. You may also have some long-term liabilities. In this example, we have a bank term loan, and that might be given to you by the bank over a period of maybe 5, 7, 8 years and is gradually repayable. So it's not an immediate item that has to be paid in full, but there will be a regular payment due. And if we then add up everything at that point, we have a figure called net assets, which is really what the value is that belongs to the shareholders. And you can see that when we look at the shareholders and owners' funds. And these consist of share capital or owner capital, and that would be money that you as the business owner put in to get the business off the ground. And the second figure is retained profit, because each year when you make a profit, it's unwise to take all of it out of the business. You generally would leave some to be reinvested to help your business to grow, and the owner capital plus retained profits equals the total funds that you have as an owner in the business. So you need to understand and use these reports to manage your business, and the next step is really to have a look at the detailed videos for each of these reports, and I'll go into a bit more detail about them to help you try and understand them a bit better.